This is FRM Part 2, Book 4, Liquidity and Treasury Risk Measurement and Management, and the chapter on liquidity risk. This chapter is taken from one of the John Hull textbooks, and we've read some of his chapters before. And I bet I told you that I have used his textbooks in my derivative securities classes before. And his chapters and his textbooks tend to be highly technical. And this chapter, it kind of wants to get technical, but it falls just a little bit short of any kind of mathematical complexity. You'll see that when we get to a future slide. But look at the learning objectives, just 4 of them. The good news for those of you who are technical is that there is an explain and calculate. And we're going to add, kind of a liquidity adjustment to our traditional and regular old value at risk. And we're going to look at a couple of cases, actually 3 of them, one of which was a longer case that I believe we discussed at great lengths back in Part 1. Then we'll go ahead and look at Basel III, see what that group has to say about it. And then we'll talk about liquidity black holes in the last slide deck or 2. I remember when I was a freshman in college, I had a physical science class. It was the first time I ever learned about the planets and the stars and all that stuff. And this concept of a black hole where the mass is so great that even light can't escape from its gravitational pull. So when I read this learning objective and I saw liquidity black holes, I thought this can't be good news. So let's go ahead and wait till the end of the slide deck to see what that holds for us. So let's go ahead and start out like we do regularly with a pretty simple definition. Liquidity trading risk that an institution fails to sell its assets within an appropriate amount of time and at a desirable price. And of course, what follows there is because the institution has liabilities that are coming due. Of course, liquidity differs from asset to asset. U.S. Treasury securities are super liquid, and maybe a bond issued by a company that has a CC rating probably has substantially less liquidity. But I do like this illustration there. Notice that in the middle, in orange, determinants of liquidity risk. And there's really nothing interesting about the placement of the different colors around the center box. But let me just go through these quickly here. This sounds like a good application question on an exam. Tell me about liquidity risk, and they give some examples. One example could be size and frequency of trades. We'll talk about that in just a few minutes. Asset type, which we just talked about above, trade customization. Is this a standard contract, or does it have all these special details because the client has special needs? Of course, the economic environment, I always do this to my students. Is the economy going like this, or is the economy going like that? Is it contracting or expanding? Number of market makers, which will probably influence the trade completion time as well. Now, I learned very early on in my graduate school days that there were actually 2 prices for every financial security. One price that you could buy at and one price that you could sell at. And, this is going way back to the late 1980s. And so I always remembered BBB. The bid price is the price that the broker was willing to buy. Back in the old days, we called that individual a broker. And so notice what that first block point says. An asset is sold at the bid price and purchased at the offer price. And so if you're the market maker, you have a built-in mechanism under which you can buy low and sell high. And so that represents the market maker's total revenue. And out of that total revenue has to come all the costs plus some compensation for being in the market. This is a graph taken right out of the chapter, and at first glance it seems relatively easy, and in fact it is. But I'm wondering if it's not really a perfect description of the relationship between price and quantity. It looks like the red line. That's not red. What kind of line is that? It's kind of reddish line, and the blue line. It looks like they're parallel to each other. up to some quantity size trade. And I suppose on average that's true. But I actually have read bunches of academic articles that show that the difference there, it fluctuates, depending on a couple of different components, including one is information. So I'm okay with that going like this. But then it looks like they really diverge out in large quantities. And of course, if you're trading, let's say tens of millions of shares all the way out to the far right versus just, a couple 100,000 shares over on the left, those two prices are clearly going to diverge. I'm not sure they diverge by that amount, but the illustration is accurate. And the reason that they diverge so much out there at large quantities of trading is because the cost of hedging for the market maker becomes great. I mean, let's think about it. The market maker has to replenish his or her inventory. And so if the market maker has, let me just pick a number, has, 1 million shares in his or her inventory, and you come in and say, hey, I want 10 million shares, well, then the market maker has to go out and buy those and has to go out and replenish his or her inventory. Now, the more important part of the learning objective, I think, is this slide here. So we've got a dollar bid spread, and that's just the offer or the ask price minus the bid price. But what's even more important is the proportional bid offer spread, where we take the offer minus the bid, and then we divide by the mid-market price, which is, halfway between the offer price and the bid price. Now notice that final block point down there at the bottom. This is probably a great exam question. The lower the proportional bid offer spread, the higher is the liquidity of an asset. In other words, for the market maker, the easier it is for him or her to replenish his or her inventory. Now, one of the interesting parts of the beginning of this chapter is this concept of a cost of liquidation. In other words, how do we measure this liquidity trading risk? And what Hull does for you is break this into two types of market: a normal market and then a wild, stressed out market, which we'll do in just a few slides. But this calculation is relatively easy. So there's that good old formula, cost of liquidation. So we're summing from position 1 all the way up to position N. And all we're going to do is take 1/2 of that proportional bid offer spread times the dollar value of the security's position. And that's going to give what Hull calls the cost of liquidation. And let me show you how that works here in an example. Let's suppose that we own 2 million shares in a Hong Kong financial institution, 1 million shares in a base metals company, and there's bid price and offer prices over in the far right column. So we need to do just some quick math. Here, hold on, let me just go back here. We need to do some quick math. This is all we're going to do here. We're going to do some subtracting and then some dividing. So the spread, what does that give me? 50 cents and $1. And then we need to calculate the midpoint, so that's an easy calculation. Market value, let's go ahead and multiply, what's that, 2 million shares times that mid price or that mid market value. So we get about $40 million for each position. And then we can compute that proportional bid offer spread. So in that second box, we have some relatively simple mathematics to compute. And then all we're going to do, here, let me go back right here. All we're going to do is sum from j equals 1, right? We have 1, we start with 1, and we end up with 2. So we're just going to sum 2 of those. And that's what we do here. And so the cost of liquidation, so what does that mean? We've got about 40 million in each, so we've got an $80 million position, right? And the cost of liquidation, because of the differences between the bid and the offer price, is about $1 million. But now what Hull then does for you is consistent with what we've talked about, over the last multiple chapters about stress tests and risk management principles and all that good stuff, what Hull wants us to do is he wants us to be able to compute this cost of liquidation under a stressed market. And so in order to do that, we need some extra input variables. We need a mean. So there's the Greek mu, and then we need a standard deviation. So there's the lowercase sigma. So notice the formula is identical except for the stuff inside of the parentheses. Now the lambda there is a reference to assumptions of normal distributions, again with a required confidence level, and so we'll just use 2.326 assuming a normal distribution. So here's the same information that we just had before with our 2 million shares and our 1 million shares, but now notice on the top right we need some extra information. So we need the mean bid-offer spread, and we need the standard deviation of the bid-offer spread. So there's extra information that we need, and then the calculations below are pretty much the same, but what we're going to do then is we're going to incorporate them just a little bit differently down at the bottom. So cost of liquidation at a 99% confidence. And let me just go back here. So notice what we're doing inside of those parentheses. We're just adjusting that standard deviation by the lambda, and then we're going to multiply it by our position, right? So we've got right there, there's the mathematics of it. And if you want to pause the recording here to make sure the math is accurate or to practice it yourself, feel free to. Otherwise, let's just go on and assume that we've computed that 8.53 million correct. So here's really the cool result. Let me go back here. Same information, right? $1 million cost of liquidation in a normal market, but now, I'm just going to round. Can I say we're about 8 times more cost of liquidation in a stressed market? And so that's probably, outside of the simple math that you're required to use here in these two problems, that's probably the most interesting result. The comparison of the 8.5 million here versus the 1 million before. So let's finish up this learning objective. Remember that learning objective was to calculate. So we just did the calculation, and this is what I said earlier about kind of a liquidity adjustment. Remember when we did some interest rate risk stuff, and we talked about duration and convexity, and you had to make a convexity adjustment to compute the more accurate value of a bond or a bond portfolio. Well, although Hull doesn't call it this is kind of the way I'm thinking of it. So notice under a normal market and under a stress market, we're going to start with our regular old value at risk that we've calculated multiple times over multiple recordings in the past. But then we're going to add this, what I think of it as just kind of a liquidity adjustment, much like that convexity adjustment was required for bond valuation. And so Hull calls this liquidity adjusted value at risk. It's just regular old time value at risk plus this adjustment of, well, in the purple market up there, that would have been plus 1 million. And then under the orange market, that would have been plus 8 million. How about liquidity funding risk? This is the ability of a financial institution to finance its cash needs as they fall due. And so let's not look at this just from a financial institution standpoint. Let's look at this just from a gigantic business standpoint. What do we know about cash flows? We know cash flows are up and down, right? That's just kind of the nature of a dynamic economy. But what do we know about the bills when they come due? You guys know this when you sit down at your kitchen table and pay your bills every month. Those bills, are they flat? No, they don't seem to be flat in my household. They seem to be upward sloping in my household. But anyway, so they're flat. And so cash flows go like this. So we need liquidity funding issues here. Now, the important thing for a financial institution, and look at that block point there, this is important because even a solvent firm can collapse if it cannot convert its assets into cash. And notice what I'm saying there, quickly enough. Now, it's particularly important when the firm has predictable cash requirements. Very simply, what do we have in our house? Pay to the order of the mortgage, pay to the order of, car, pay to the order of cable, pay to the order of electricity, all that stuff. But for a financial institution, it knows that it's going to have to make some coupon payments and principal payments, et cetera, et cetera. Now, sources of liquidity. Boy, this could have been taken out of a like an introductory business textbook here. So this is not too complex. I'm guessing you guys know about this, sources of liquidity, but it is part of the learning objective. So this ought to be a pretty easy question if it ever shows up. So, there's a circle there, right? Those arrows keep going. So there's not really a starting place. So what are sources of liquidity? Of course, cash. That makes perfect sense. And then treasuries, because treasuries are super liquid deposits. Oh my gosh, bringing in the central bank. Do we really want to go to the central bank, or do we want to consider them as the lender of last resort? Other lines of credit, securitization. We've talked about that at length. We have all these mortgages on the left-hand side of our balance sheet. Why don't we just package them together, put them into one big pool, and then sell them? And then trading book liquidation. How about that? Learning objective on 3 short cases. So we'll do this over the next 3 slides here. Northern Rock, fast growing lender. And so you can imagine what that means. Fast growing lender, boy, they have large scale of mortgage-backed securities as part of their investments. But here's the interesting thing about Northern Rock is that it did not rely on customer deposits for funding, but instead it borrowed heavily in the international money markets. Now, of course, part of this was in just regular old money markets out there, but it also went substantially inside of that interbank market. Now, of course, we've got this housing bubble burst in residential housing, sometime in mid to late 2007, and their global funding channels all dried up simultaneously. That sounds an awful lot like some type of a liquidity crisis. Do I want to call it a liquidity black hole? Well, let's wait for a couple of slides to decide on that one. Now look at the lesson down at the bottom. A more conservative assessment of funding availability could possibly have averted the crisis. But I'm going to go back to my old saying to you guys, and it's going to show up here in another slide or two. Identify risks, quantify the risks, manage the risks. Regardless of what those risks are, if you do those 3 things and you perform those acts with excellent due diligence, then you're going to have a great possibility of averting a crisis. How about the Ashanti Gold-fields? This is a gold mining company, and if you're in the commodity business, once again, your cash flows go like this because the price of gold goes way up and it goes way down, it goes way up and it goes way down. So, of course, whether you're on the buying or the selling end of a commodity, it makes perfect sense to enter into forward contracts or futures contracts or some other kind of derivative security. So, Ashanti did this. It sold lots of gold forward contracts. Now, let's think about what was going on here. So we have these, let's suppose the price of gold is $1,000, right? So you have this $1,000. So you're out there digging in the fields and you're digging up the gold and you can sell it for $1,000. Well, now if the price stays pretty constant, well, then you don't really have to worry about all that fluctuations. But of course, the price of gold fluctuates. So in order to protect downward pressure on prices, Ashanti simply just sold gold in the forward market. And so maybe they agreed to sell it at, $1,050 in 6 months or 12 months or 2 years or 5 years. And so think about what what happens then? You're agreeing to sell your current inventory at a higher price in the future, and that makes sense to compensate you for, the cost of storage and all that other kind of good stuff that we learned in the pricing of forward and futures contracts. And so this is a contract, right? So Ashanti was locked into that $1,050. But what happened was that in fall of 1999, 15 central banks announced they would limit gold sales for 5 years. So there was a gigantic spike in demand, and the prices then rose 25%. So what did I say? Spot price was 1,000, forward price was 1,050. But now all of a sudden, that spot price increased to $1,200 or $1,300. And so think about this. So you're agreeing to sell a commodity at $1,050 when if you didn't enter that contract, you could have sold it for $1,200 or $1,300. So of course we have margin calls, and then this asset. It's increasing in value, but it became highly illiquid because of those locked-in, guaranteed forward contracts. Now, how about the liquidity crisis at Metallgesellschaft? How about if I just say M-Shaft here? And this was one of the substantial cases that we talked about back in, a long time ago, let's say, but somewhere in our history of recordings. International conglomerate firm. Trading, engineering, a bunch of other stuff. So this goes back to 1992, and what happened was that M-Shaft agreed to sell energy, like barrels of oil, to all of its customers at a price that was higher than the current spot price. So what it did is it took the short position in one of these forward contracts, but these were long forward contracts. Now, of course, in order to hedge, remember, just like gold goes up and down, price of oil goes up and down. So in order to hedge, what it did is it took the opposite position. It took the long position in short-term futures contracts. And this was working well as long as the futures price was less than the spot price. And so there was a profit margin there of between $3 and $5. But the price of oil fell, and there were margin calls. In fact, the spot price fell dramatically back in this time. Look at that, cost $1.5 billion. How about that third learning objective, getting into Basel? We spent a lot of good time talking about Basel, and in fact, we have talked about the liquidity coverage ratio and the net stable funding ratio. So I'm going to go through these pretty quickly. This should be just somewhat of a review. Notice for this liquidity coverage ratio, we've got high quality liquid assets in the numerator. So what are these high quality liquid assets? However you want to call them, maybe a Treasury bill, throw that in there along with other high quality liquid assets. Divide that by the net cash outflows in a 30-day period. And so what we're hoping is that this ratio is greater than 1. Key considerations, this is what I was suggesting earlier in that numerator, determining the types of assets that can be relied on to meet the liquidity needs. Like, for example, I put up my calculator here regularly. My calculator is not a highly liquid asset, so you wouldn't want to put that in the numerator. But you might want to put a certificate of deposit up there that is maturing in less than 30 days. Now look at the second circle point here. This is really critical. Quantifying the bank's projected liquidity needs, especially at times of high stress. Now, how about this concept of a net stable coverage ratio? All right, look at that numerator, the available amount of stable funding. So stable sources, which means that we want to reduce the dependency on short-term just wholesale funding, right? We want to mitigate funding risk. And notice what we're trying to do here. We're trying to eliminate, is that the right word I want? Eliminate the mismatch between the time horizons on the left-hand and the right-hand side of the balance sheet. So this net stable funding ratio, we want to exceed 1. Now, the Basel III also suggested some best practices, sound liquidity risk management, and these should not be a surprise to you. So in order to have sound liquidity risk management, what should a financial institution do? Robust liquidity management framework, articulate liquidity risk tolerance, manage liquidity risk, identify and consider liquidity costs. What are those first four sound an awful lot like things that we talked about in the past for, third-party risk management, credit risk management, market risk management. So, these policies really are not unique to liquidity risk management, but they're unique in that there are some liquidity issues that, of course, are not relevant for market risk and third-party risk, et cetera, although there is lots of overlap. Look at number 5. Boy, you guys want me to read that? An effective procedure for identifying, measuring, so I use quantifying, tracking, and controlling liquidity risk. So identify, quantify, manage. Here we go. Manage intraday liquidity positions. Among the worst things that you can do is just, make a trade and then go out to lunch for several hours and then come back and say, boy, I hope nothing bad happened. Remember that it doesn't have to be a stressed market for for a market to move against you. Manage collateral position. We've talked at length about that. Strategy that offers adequate diversification. Remember that diversification is going to reduce market risk, but it's not necessarily going to reduce liquidity trading risk. Strict contingency funding plan, that's all part of management. Liquidity risk exposures, boy, we spent lots of time talking about exposures, and so that applies equally as well in the liquidity arena. I like number 11, regularly reveal public information. This is what I learned, one of the things that I learned from a couple of my graduate school professors is a responsibility and stewardship of financial managers or corporate leaders to go ahead and make public information that is currently private as soon as possible, as quickly as possible, as transparently as possible, even if it's bad information. Keep a cushion of unencumbered, high-quality liquid assets. So remember, unencumbered means it's not tied to any collateral. And then 13, employ stress tests regularly. We've heard about that for multiple chapters. And then what should supervisors do? Right, comprehensive assessment. So, think about this big umbrella, and you got the chief risk officer up at the top, and then you have all these silos. Remember, we called these business units or business lines, and so you have the manager in charge of all these. So each of these managers ought to do this comprehensive assessment for its business line, and then have that flow up to the chief risk officer, and then that chief risk officer can then put together a comprehensive assessment of the bank's overall liquidity risk. Communicate with authorities, of course. Take corrective action, of course. And then have standard liquidity assessments. All right, how about this concept that I fell in love with? This is back when I was 19 years old learning about black holes. A liquidity black hole occurs when a market exhibits dried up liquidity because of everyone wanting to take the same side of the transaction. All right, so what is a black hole? This giant mass, even light can't escape its gravitational pull. So what are we saying here? So you have this gigantic mass. So think about the gigantic mass as stuff on the balance sheet for a financial institution. And so that liquidity, can I sell a Treasury bill? Can I sell a Treasury bill so I can meet my coupon payment over here? Well, if there's dried up liquidity, then I won't be able to do that. Race to the bottom or exit, where a decline in price leads to a situation where everyone wants to sell. Financial traders lose confidence, et cetera. When I was in graduate school, we learned about the global crises that occurred in the early 1980s. And then I was a professor during the Asian crisis and the Russian debt and long-term capital. And so those are examples of liquidity black holes. And it doesn't take much research to go back and to read about these crises and say to yourself, oh yes, this sounds an awful lot like light not being able to escape from this giant mass. And then the final part of that last learning objective asks about the difference between negative and positive feedback traders. So negative feedback traders, they buy when prices fall, sell when prices rise. Positive feedback traders sell when prices fall and buy when prices rise. Of course, negative feedback traders, you could call them contrarians. But here's the important part. Negative feedback traders can dominate trading in the liquid markets, but positive feedback traders dominate trading in illiquid markets. And so that's probably the big takeaway for that learning objective. And then the very last part of this chapter puts together a couple of reasons why positive feedback trading is so, let me go back here, where positive feedback trading is so prevalent in illiquid markets. So trend trading, stop loss rules, dynamic hedging. And remember that dynamic hedging, although Hull just talks about call options or put options, there are lots of ways to do this. I love this, creating options synthetically. I learned about this in graduate school, and synthetic derivatives they're really a cool animal out there. And so you can use those to do all sorts of hedging. And then margins, we talked about that, and predatory trading. And I think that takes us through our learning objectives. And so, I'm guessing that first learning objective is probably at the top of my list for importance. But I'm also guessing that the ratios from Basel III are important as well.